Are you thinking of buying a house, but you're confused about different types of loans? You may be asking yourself, which loan is the best one for me? Which one should I go with? What are the differences? Let's go over those in this video that starts right now. Hi, I'm Chad Scott of eXp Realty. If you're new to my channel, thank you for stopping by. I hope that you enjoy this content. If you're returning, thank you so much for supporting me. As always, please hit the subscribe button down below and the bell to be notified of new videos that drop every Monday at 10 a.m. When you're ready to start looking for a house, most people start looking on Zillow.com, Realtor.com, other home websites. They look for houses that they like and houses that they want to see. Once they find a house or two that they want to see, they call their trusted realtor and say, I want to see these houses. And they go out and look at them. After showing you a house or two and getting to know what you're looking for, one of the first things that I'll ask you as your realtor is if you have a pre-approval or not. If you don't have one, it's okay. It's not a big deal. I work with a lot of really great lenders in the area here that can definitely help you get one really fast and for free, of course. So your lender will help you choose the best loan that's right for you and your situation. But you may still be asking, Chad, I want to have a leg up though. I want to know what these different loan types are. So let's review them real quick. Basically, there's two types of loans. There's government loans and there's conventional loans. Let's break down the government loans first. Under the government loan umbrella, there's three types of loans. There's VA, FHA, and the USDA loans. VA loans are very appealing because you don't have to put any money down. Everything can be rolled into the loan. However, you do have to be an active military member or retired, or the spouse of a retired or active military member. FHA loans are a government loan program where you can put as little as 3.5% down for your loan. They also have very lenient credit profile standards. So if your credit is not quite where you want to be, not 100%, maybe your credit score is a little bit low, FHA may be the best option for you because they don't require as high of a credit score as conventional loans do. USDA loans, the final loan program under the government umbrella. You can also do zero money down for USDA loans. However, they have location requirements. In Kenosha County, you can typically only use a USDA loan out in the county. So pretty much anywhere west of the interstate. If you're looking to be in Kenosha or Pleasant Prairie or even Racine, you're not going to be able to get a USDA loan. It has to be west of the interstate. And in Lake County, I don't believe there's any areas in Lake County that you can do a USDA loan. Let's talk about conventional loans. So conventional loans, every lender has their own loan program. So they're different between lender A to lender B. But typically every lender has a conventional loan where you can put as little as 3% down. But they have much stricter guidelines for your credit profile. A conventional loan, you typically have to have a credit score of at least 720. Whereas government loans, you can have a credit score as low as 600 depending on the lender. These credit score minimums are always changing though. So it may be 600 today, but tomorrow the government may raise those minimum credit scores to 640, let's say. So check with your lender and see what those minimum credit scores are, and they'll tell you which loan program you best qualify for. So what are the differences between conventional and government loans? Well, conventional loans, you can put as little as 3% down, whereas government loans, the minimum you can put down is 3.5%. I know it's only 0.5%, but depending on the size of the loan, that can be a big difference. Conventional loans require a good credit profile, whereas government loans are a little more lenient when it comes to things such as your credit score and other things that affect your credit profile. Conventional loans only require private mortgage insurance, PMI, if you're putting less than 20% down. FHA loans and VA loans, they require PMI no matter how much you put down. So even if you're putting half the loan down in a down payment, you still have to pay PMI, private mortgage insurance. You may be asking, what is PMI? Well, PMI is an extra amount that you have to pay in addition to your normal principal and interest amount that goes to the government in case you default on your loan. So that way they can recoup their money, make all their money back basically. With a conventional loan, PMI can be removed when you're at 80% loan to value. With an FHA loan or VA loan, PMI is there for the life of the loan, no matter what. No matter how much you paid, PMI will always be there with a government loan. With a conventional loan, the PMI is based on your credit score and the amount that you put down. So the more you put down and the higher your credit score, the less PMI you're going to pay. With a government loan, the PMI is the same amount for everybody, no matter what. Conventional loans require a lower debt to income ratio, so you have to have less debt basically, whereas government loans are a little more lenient. You can have a little more debt to income and they'll still approve you for your loan. Conventional loans also have stricter guidelines for credit events, such as a bankruptcy or foreclosure. For a conventional loan, a bankruptcy has to be discharged at least 4 years ago and a foreclosure at least 7 years ago. Whereas FHA, government loans, they're a little more lenient. A bankruptcy can be discharged only 2 years ago and a foreclosure only 3 years ago, and they'll approve you for a loan. Both loans can be used by your primary residence, a secondary residence, or an investment property. However, FHA guidelines are a little bit stricter when it comes to buying a secondary residence or an investment property. Just because FHA and government loans are typically used for your primary residence, so when it comes to buying other residences like investment properties or second homes, government loans are just a little more strict when it comes to that. So usually if you can, you want to go a conventional loan when you're buying your second house or investment property. Whenever you're borrowing money to buy a house, they always do something called an appraisal. We'll do a video on that another day. So conventional appraisals are a little easier. Really all they care about is to make sure that the house is of value, that you're not paying more for the house than what it's really worth. Government appraisals, they're a little more strict. They have a longer checklist of things that they check for when they go to look at the house. They look at things such as, do all the stairs have railings? They want to make sure that there's no chipped and peeling paint. They make sure that the roof is not too old, not ready to fall in. Make sure there's enough insulation in the attic. Just what they consider safety things. They check to make sure there's a smoke and carbon monoxide detectors on each level of the house. So when you're choosing your loan type, that's something to consider. Will your house pass a government appraisal? That's something to talk about with your realtor and with your lender. Make sure that you're choosing the right loan type. Definitely talk to your lender about which loan program you qualify for and which one is best for you. If you like this video, please check out any other videos I have on my channel here about the buying process. They're all great videos and very informational. Thank you so much for watching. Hit the subscribe button down below and the bell to be notified of new videos that drop every Monday. I'm Chad Scott with FHA Realty. Have a great week, and I'll see you back here next Monday.